The broadcast is now starting. All attendees are in listen-only mode.
Hey everybody, let me know you can hear my voice and see my screen. Good to see some familiar faces in the group. What's up, Don? He's got a fire in Seabright yesterday. That sucks. All right, hello from Colombia. Hello from the U.S. All right, good to see everybody here. Arnie, what's up? Gord, Samson, Devon. All right, starting with our disclaimer, even though the markets are off at this moment, we're still always aware of risk. Trading involves risk of loss of all of your trading account or more. Always use only discretionary funds when trading. Never trade any market with money you cannot afford to lose. I'll welcome everybody to a Saturday night kind of hangout. We're rather informal, but just understanding that we're going to be talking about the WSM Viewer. I wanted to put together a follow-up to my previous session that I did with you all on Tuesday, and we were talking about this thing called the London pattern. Now, if you remember going back to Steve's original class, he showed you a pattern. In fact, he showed it in the free recordings that he did. I remember I recorded about 5 of those. I think I've got cell phone images of them. I recorded off the cell phone, and I remember him going into detail about this setup called the Type 1 London pattern. And if you recall from those days, he said go back and look at them in the charts. And I'm not sure how many people actually did go back and look at them in the charts, but I want to assure you that in our WSM database, there have been 338 of them. So, and that's going back to 2017. So let's just use our heads here from 2017 to current day. I'm going to say there's roughly 300 of these. So 150 of these Type 1 London patterns a year, starting from 2017, right? So what I want to do is I want to just talk about the idea of what do you do after you have access to the WSM Viewer? What do you do after you're synced up with this signature trade? So we're going through all the months here of these London patterns, and we can pare it down, obviously, to London only. You can see some of them showed up in New York. But that's a significant amount of trade setups for a year, 150 trades. All right, so I want to talk about this for a second. If for the next 20 minutes, I walk through all the Type 1 London patterns, I'd have to put one up on the screen every 3.5 seconds. Okay, not sure about you, but that sounds like some subliminal stuff to me. I don't know if that's practical. You can see down here 338 of them. Now, again, I could strip out the New York versions of the Type 1 London pattern, of which there were 45 of them over the past 2 years. Strip those out and go straight to just London. That's still 293 of them. That leaves us with about every 20 minutes, one every 3.5, more about 4.09 seconds. So I don't want to flash these to you. I wanted to go through all these London patterns with you. But again, it's a time factor, right? Steve asked us to keep this to about 20 minutes. So we're going to do our best to do that. The issue, obviously, that you're going to face with this is, yes, you can go back and see 300 of these in the viewer perfectly laid out that look exactly like the slide. There's no difference. Slight differences, obviously, we've got. In this case, this is one from this year. This is from January 7th, right? It's the same idea. You're still dealing with this M above the Asia range. Remember, they're doing the false move typically above the Asia range. And then it collapses over nicely for a pretty nice trading day. Okay, so the London patterns, obviously, when we're looking at them on a fixed chart, we see them like this. It's something that to our mind looks like a completed trade, and it's obviously easy to say, yeah, I could have taken this trade in here. Let me get a different color so you can see it better. You could obviously take this trade in here. It looks easier to take that trade when you're looking at a completed chart. But if we roll back into it, what I want to show you is this unique perspective that almost all of these London patterns have before they turn into a completed London pattern with the shift. And let's even include the shift in there. Let's include this area where we have our entry signal. Notice that this is still a channel long. This is how, when you start looking at these trades on the edge of your charts, they become far more meaningful because you realize starting out your hesitancy towards taking a setup that looks like this is that rising wedge. It's just innately hardwired into you to want to follow momentum as an early trader, as somebody who's beginning to trade. And unfortunately, to the untrained mind, this has absolutely no look of being short, right? You can see the drawing. It's a channel to the upside. This is a channel to the upside. That's what most people see. And in fact, most people see the pullbacks at the edge of these, the second leg, as a possibility to get in long again to ride this channel up. So we can take any of these London patterns. It really doesn't matter where we go. You're going to see on the first side of the London pattern, it always shows itself as a channel. And so what you're left with is this idea of confidently getting short in here, even though time is running by slowly. We still see the channel. We still see the channel. This is the illusion that goes on. And then once they shift it out of there, then maybe down here you start to say, oh, it finally looks like it's short, but it's too late for me to enter the trade. What's the point? They don't happen that often anyway, right? The head talk gets in, and then maybe later in the day you see that it played out all the way. So what we want to do with the WSM viewer, the prime reason for it, is we want to create visual triggers. And a visual trigger is where you see a setup that's confirmed on the edge of price. I think you might even, this looks more like what most London pattern type ones look like, where you have the leg that closes below the 13 EMA and is ready to go. In this case, we had the pullback, which offered some nice pullback entries, which we talked about 2 weeks ago in my DMR. Talk about technically getting in there. There's a zone in between the high and the low where you've got that ability to grab these pullbacks and actually get a better reward risk because your entry's up here and your stop loss is up there. Okay, so all of you EMA crossover lovers, you're going to see all sorts of fun stuff working on this one to give you a sense that it's a good trade. But anyway, what I'm saying is that you create these entry triggers. So I create entry triggers on successful type 1 London patterns or whatever your signature trade is. Obviously, the viewer can manage any type of signature trade you throw at it because all it takes is Control Shift A and you can add in where your entries are. And you're basically your signature trade. And they all have various names. We've got intraday 50-50 bounce, intraday safety, AR50, Asia range 50 bounce, Asia range 0-0, Asia gap 1-2-3. Those are my favorite, right? So we have, well, not favored as in an exotic trade. I don't trade them normally, but it's a nice, it's when they set up, they're really solid. We've got safety, New York reversal, type 1, type 2, type 3, London patterns, and so on. So you can be putting in any type of signature trade in this viewer, but the main idea is that you're loading in the trigger entry. Right? It's a visual chart that's the trigger entry, and it's the way our subconscious mind works. Our subconscious mind doesn't understand this. It doesn't read this as a setup. It reads it as a setup, but what you're training your subconscious mind to do is you're training your subconscious mind to recognize the setup when price is all the way down here, as opposed to taking this right on the edge. Now, the second part of this, which is even more interesting, is that when you become adept at identifying the first leg of one of these type 1 London patterns, you can see even on the higher time frames, we have all our lovely EMA activity happening here. You've got price blocking occurring quite nice. So you want to be ready to be able to recognize the first leg of a London pattern. Now, if I just drop this chart in front of you tonight and we ask the question, what do you see here? I think there'd be a scant few that would say, oh, I see the possible first leg of a type 1 London pattern. I probably should have just done it that way. But you'll understand that if you don't familiarize yourself with all of the looks into a setup, all of the variations into a setup, you're basically relying on your memory and it's going to create false images. It's going to fill in stuff that's not there. So what we want to do is we want to give the memory the absolute pictures of what any setup looked like as it was preparing to fire, right? As it was preparing to make its move. And the way that this setup particularly happens is they come up and they hit a lot of additional breakout volume to the top edge. So they're triggering people long right here. Again, look at this channel. A lot of people trade momentum. Okay, I'm not sure if you got into it that way, but certainly the first robot I bought, crap EA, was a trend following robot. And now we've got some pins to the high, and then it finally collapses down below the 13 EMA. Now our trigger is fired. Now we want to think about loading in. You've got 37 to the high of the day. So this is what I like about the WSM viewer, is that our HUD travels right along, so you can actually get a sense of how close you are to the high of day. So we're 37 pips from high of day. I want to think about taking this pullback. Okay, again, 2 weeks ago I did a DMR about how to mechanically take that pullback. Okay, and then they roll right over, create a set of railroad tracks, and it's gone. But during this entire time, all this time in here, the chart's showing the channel long. You have to be smarter than what you're seeing on the chart. You have to think, well, I've seen 300 of these, well, to be quite exact, let's see, 338 of these. If I've seen 338 of those, I pretty much know it's still a valid type 1 London pattern, but even though the channel is showing long, I'm going to stick with it. And then it eventually obviously plays out. So you're going to have that battle inside your head down here unless you've actually put in the image of your signature trade, doesn't matter what it is, on the hard right edge of price. Okay, so signature trades on the hard right edge of price, immediately accessible in the viewer for quite a lot of reasons, actually. And so what I want to do is, now that my charts have loaded, let me just go have a little look here at possibly shifting this folder. I had a little folder issue before we started here. One of my drives wasn't recognized by the computer, and that was a little inconvenient, but we should be able to power through this. No problem. Okay, so I have all of 2018 loaded up, so we can go flip through those. So again, you're going to want to familiarize yourself with these type 1 London patterns on the edge first. Okay, so that's the first thing you want to do. And let's go down into 2019. Let's see what we have here in 2019. Come up here, just randomly pick one. Okay, same idea. This is the 14th of January. Same idea, break of the Asia range, pulls back down, taps the 13 EMA, rolls around, and gives us a set of tracks. Okay, we're 17 from the high of the day. Okay, basically no pullback entry in this one, just dropped. And this is what I caution. This is something that you also want to be familiar with, is how many of these London patterns do not do pullbacks. Okay, and this one obviously rolls right over. So again, you're going to be fighting this channel upward with a type 1 London pattern when you're first exposed to it. And it's brutal unless you've really put a lot of these into your mind. You need to spend time putting these into your mind, but that's only the beginning of it. And that's why I created a little bit of a slideshow here for you. So let's talk about the second half of what needs to happen, because that's easy. Anybody can click a button and go look through hundreds of London patterns. The question is what you do after that, right? And that's when it comes to this image here of the scribe. And what you really want to do when you're serious about your trading is you need to develop a win-loss ratio of any trade that you're going to trade. And this is we'll call it the weak link of probably 90% of new traders out there, maybe even 100% of new traders out there. Human behavior doesn't change. The crowd stays the same. They do what they do. The people see these channels rising. They take the pullback on the channel for their possible lightning bolt structure, and they think it's going to go up, right? And then they eat it, and that just goes on night after night, day after day. Okay, you need to get your win-loss ratio, and you need to create what are called realistic expectations. And to generate realistic expectations means you have to go through this process. And I want to lay this out for you, and this is especially for the people that are with us now. And of course, the guests are along, obviously, to see what's up with the viewer. But what I want to do is point out to anybody who's part of our membership, remember, I am always identifying these top trades every week. So on Fridays, I post what the top trades were. I do type 1, type 2, type 3 London patterns. I think we had 36 trades posted Friday night, meaning 36 what I see are solid setups through the week. And I do some of Carr's material as well. I do ID 50s and in some cases ID safeties. And there were about 5 ID 50s last week that look absolutely perfect. And it's all right here in this database. So you can click through all of these. But at a certain point in time, you need to take that next step up. Okay, so you're familiarizing yourself with the channel. You're saying, all right, I'm not going to take this long. I'm going to be able to take it short if it's a London pattern by the rules. But then I've got to get into this idea of generating realistic expectations. Because the first thing that happens when someone gets a signature trade like this, that happens 150 times a year. The math says it happens about 150 times a year. We get a type 1 London pattern going back 2 years. So that's 2 years of data, which is enough for this type of trade setup. But certainly you'd rather have more, maybe 4 or 5 more years of data. But 2 years is immediately available. And what you're able to do then is generate this realistic expectation. How many do I typically see a week, right? What's the typical quantity of stop outs? Because you can't, with any signature trade, expect them all to work out. There are going to be some of them that look just like this. And they might turn right here and go long. You have to get in your brain the reasonable expectations of the statistical quantity of stop outs. And this is where some people, you're going to fuzz over. You're going to get a little, I don't know, fuzzy minded on me here, but that's all right. We're going into math for a second. I don't want to scare you. All right. So generate reasonable expectations of a statistical quantity of stop outs. and how many trades a week to statistically expect. Now, here's the interesting part. And this is where it gets very difficult. This is why this particular trade, this setup, has turned off a certain amount of members in our group. I don't know what it is. For the longest time, at least I didn't think I knew what it is, but then I figured out what it is. I did figure out what it is. So let's go into last week. Type 1 London patterns. How many? Two. We only had 2 last week. So most people, if they see 2 setups, they see, well, gosh, I don't know if I really want to take this signature trade. It might not work out for me, right? Might be too few, right? So there's this weighting component. We go back to the previous week. Obviously, we see 10. That was the week we went through on Tuesday. And the week before that, we had 5. The week before that, 6. The week before that, 7. Okay, so you can see a rhythm here. December 10th, week of December 10th, you had 7. A week of December 3rd, you had 6. So there are these outlier weeks where there aren't that many. Don't you find it interesting that the very week that we talked about it, there weren't that many? Well, that's what spooks people out. And that gets into these clusters of wins and losses, which is very important to cover. Okay, because what you want to do is you want to say, okay, there are only 2 that set up last week. Maybe I took a couple that looked like they were going to be London patterns and they didn't turn into one. I'm going to go off to another signature trade from here. So we get system hopping a lot. People will take one signature trade, and because they get a couple stop outs, they jump to another one. So that's where you have to be the person that's looking into this material, like one of these scribes, at a greater depth over a longer period of time. And you're going to find the weakest link of even the best trading strategies is the consistency of the operator. Even the best traders are wrong a given fraction of the time. Perfection is to be found in the execution, never in the strategy. The strategies are always going to be susceptible to even 2% losses. If you had a 98% accurate system, 2% of the time you're going to lose. And obviously we're looking at 80s, maybe 70s, 70 to 80%. You're still going to lose 3 out of 10 trades. What are you going to do when that happens? Okay, so that's very important. And you're going to find out when you get stopped out. Let's say, for instance, you're like, okay, Jim, I'm going to take these type 2 London patterns. Here's one I see that set up in EC last week. I saw that I was in level 3. It looked wonderful. I took the trade. It worked out beautifully. I feel good about it. I'm going to take this trade. How do I know that I'm maintaining this idea of realistic expectations? And it has to do with the question you ask when you're stopped out. The question you have to ask yourself when you're stopped out is, then there are a couple questions, right? You have to be honest. And this is the part that, this is where, you know, you, as a teacher, as an educator, you want to get someone across that sticky threshold to the part where they're actually going to do good for themselves. And that's when you're realistic. When stopped out, you ask questions. Am I in my strategy and this was an expected statistical stop out? Or 2, was I making stuff up MSU on a whim? Did I see it as a possible setup and I haven't studied it all that much and it looked like one to me, but it wasn't? Are you in your system or are you out of your system? And that's what you have to ask yourself whenever you get stopped out. Okay? If you get number 1 each time, you take a hit, you keep going with no hesitation. I got stopped out, I was in my system. It's exactly how I've prepared all of the rules for my trading system. No problem. I'll take another one with no hesitation. If you get number 2, you really should stop trading entirely. You should absolutely stop, because what that means, generally speaking, if you're making stuff up on the edge, you haven't sat down and really worked out a signature trade to begin with. You haven't done it to begin with. So the very simple rules we have for a type 2 London pattern, in this case it's a W, right? Our first leg closes on the 15-minute above the 13 EMA, then closes below the 13 EMA, then closes above the 13 EMA. So close below, close above, close below, close below, above. Sorry about that, tongue-tied. So that's the very simple rules of a type 1 London pattern. Is the 13 EMA provides that rule set. Close below, close above, close below, close above, and then it's gone. So that is the type of thing that one would say occupies a strategic point of reality. And if they were to take a stop out and they still adhere to that, then you would obviously not hesitate on the next one that shows up. All right, but that takes this overall view. You have to go back through all of those, and you're going to have to make some exceptions, because there are some of these that don't actually close above the 13 EMA. They come up and tap it, close below again, and then close above. How do you feel about that? You would really want to get to the point that you're absolutely clear what all the minutia are of your trading rules. And this is something that's self-generated. Let's take 100 trades. In any group of 100 trades, one is a winner. Obviously, the dark dots in the center are the winner. The outside are the losers. So let's look at a 70% trading system. This is 70%. So there are 30 dots in here, 30 red dots, and the gray dots basically signify a win, a winning trade. Okay, let's ask ourselves the question, and this is what I see come up with this type 1 London pattern. And now I want to just put a bookmark here. This London pattern is created 100% by the dealers, the market makers themselves, back of the dealers, way above even the liquidity providers, 100% manipulated. So they have to spend the money to push the market down. They obviously let the market rise, and then they have to spend the money to push it down again. And then when they get enough people short, they pull back away, and off it goes. So this is 100% manipulated. What does this mean? This means that that trading system requires the market makers to actually be creating the setup to begin with. And I don't want to leave the impression that the market makers themselves are 100% responsible for this, because they have to respond to what's going on in the crowd. It's the human behavior that doesn't change. When the market makers do see enough people seeing this channel short, here's another example. It's a beautiful channel short. Even this pullback, right? You can see the pullback before it breaks comes right to the channel. So that channel short, to a certain amount of people, it's a pullback. It's a discount on the short entries that they're going to make. And so they get in short here. So it requires the crowd to be involved as well as the market makers. But what I'm trying to get to is, you don't know how many of these stop outs are going to happen in one string. You may actually get 1, 2, 3, 4, 5, 6 in a row. And I've taken them off the side. So I'm relocating these bars, right? These little squares. So now your losses are 6 in a row. You haven't changed the hit rate of the overall system. It's still 70% accurate. But what you're doing is you're saying that there's 1, 2, 3, 6 stop outs in a row. Is that even possible? 7 stop outs in a row? Or let's take 8 stop outs in a row. And I have seen this with some particular strategies. I've worked on and continue to work on a lot of strategies based on the BTM system. And I've been up and down a lot of strategies. And I love designing strategies. It's one of my favorite things to do. Before I even became a member of Steve's group, I was already trading my own strategy. I had devised, it was 68% or so. I had a buddy of mine who was trading a big account that was doing okay with it, but 68 is what most of us are used to, 68, 70%. And as I got further into Steve's method, all of these other strategies started to form, and you'll be able to get that hopefully after you take in the general class, which goes through a lot of the things that are really present on this chart of this EC right here. A ton of stuff on the H1, obviously. You can see the market maker cycle super clearly, and it's a real beautiful chart. So anyhow, as you get into your strategy, especially the ones that are made by the dealers, the market makers, you don't know how many are going to drop in a row, and you need to be prepared to drop 8 in a row. I've seen it with some strategies, really good strategies. I've seen really good strategies, and it happened at the beginning of 2018. One strategy I was working on that was really, really nice. It was pretty, it's an M1 strategy, but anyhow, as I got into it, I did back testing on it. I found a cluster of these error. I thought it was an error on my part. But then, sure enough, after 8 of these went by, after about, it was 3 or 4 weeks in the beginning of January in 2018, the beginning of 2018, sure enough, the strategy picked up perfectly right as it left off, as if it never had these 8 stop outs or these 8 scratches or these 8, it didn't do what it was expected to do. So I think you understand what I'm saying here. We see a lot of times with the market makers, anytime their strategy is really clear and really developed and really moving, they can at any time pull the switch, and they can knock so many people off the bus here. If you take any trade strategy, I don't care what it is, if it stops out 8 times in a row, you're probably going to throw in the towel. You're done. That's it. I'm done. But if you are interested in your career from the standpoint you need to be interested in it, you would go back and study the entire year. In this case, study an entire 2 years of data and find, yeah, there was this little time during January of 2018 where this thing broke down 8 times in a row or whatever it was. It was basically a month if the stuff didn't work. And then it fired right back up in February, and the rest of the year was absolutely perfect. So that's the type of breathing that you have with some of these strategies. It's a lot of people don't take that in. They don't get it. Okay. So if each one of these trades was a -1.5, I basically drop 12% over the course of these 8 trades. So -1.5 risk. Now, if you're actually doing trading properly, you're making it 1.5 of your balance as the balance is pulling back, and it's only 11.39. That's exponents. I don't have time to get into that, but this is the kind of stuff that's going to be extremely important for you. Let's say you're a 3% trader and every trade you put on is -3%. Well, if you had 8 stop outs in a row, that would be a 24% drawdown in your account. Well, with compounding mixed in, it would only be 19.21, meaning that you're taking 3% off of the balance at each day as your balance is going down. So what does that mean? That means you have to be ready for, in this case, almost a 12% pullback if you're trading 1.5% per trade. In this case, you have to be ready for almost 20% pullback if you're trading a 3% drawdown trade. And I'll tell you, you'll see these clusters happen and it'll shake you. And because this stuff is market made, because you have a market maker that's behind this, he knows he's going to shake a lot of people off this very viable strategy. And trust me, it's happened to me. I don't doubt that it's going to happen to a lot of you. Get in, say, H150 bounce. It's a beautiful trade. You get in to the group, you learn how to trade the H150. All of a sudden, you take 5, 6 stop outs in a row. You're like, what the? This thing's garbage. And that's what happens. So you have to be able to accept these larger clusters. You keep your risk management tight enough that you can weather that type of drawdown. For me, I'm a -1.5% trader. That's where I am. I know there some of us are -3. I understand that too, but I'm ready to take at any point in time a 10% hit, no problem, because I know that's the type of thing that happens. So that's reality. You've got to be able to be prepared for a bunch of these happening in a row and not get shaken off the horse. This is the problem that happened to a lot of people. Okay, so when stopped out, the third question you want to ask yourself, well, I don't know if it's a question, but am I in my strategy? I took it and it was just a statistical stop out. 2, was I just making stuff up on the edge? And 3, I never went through to create a strategy in the first place and never did discover any statistical win-loss ratio. So you don't know your win-loss ratio over the long period of time. A lot of people get stuck on that. Okay, so at bare minimum, successful trading requires 5 parts chart study to every 1 part of actual trading. I went over that before, obviously, right? We've talked about that a lot, and it's the truth, and it's why the viewer is a very exceptional tool for that type of behavior. So I can actually take a bad move, like for instance, I'm giving you essentially all of the wins for all of these years, right? So you come in and you say, okay, Jim's shown me 338 type 1 London patterns. Now what I have to do is, as an individual trader, I have to go back through here and I have to pluck out the ones that did not work out that fit my trading rules. So that's where the work part comes in. All right. So every week I'm going to post the top London pattern trades that show up, and you're going to be able to respond to them, obviously, and see them on the edge. And when you see them on the edge, eventually this whole channel long thing begins to rain down on you, I guess, so to speak. In some cases, you'll be able to see it. Here's a railroad track version of it. Just a couple tracks, track up, track down. It's a small M, right? That's a variation. So as you get further into some of these trade setups, you'll start to see that, yeah, okay, I can pick the wins pretty well, but how do I respond to the ones that don't work out? And that's where you're going to have to get involved. And this is basically where we put you to work. Okay, so I know what the wins look like. I've seen the general idea. I have a sense of what the winning type 1 London patterns look like. But what I have to do is I have to go through each one of these that actually produces a loss. And this is where, again, I try to get people as early as possible to generate a win-loss ratio on their trade. So if we go to last week, for instance, GC is one of the setups that gave a type 1 London pattern. It was a stubby one, but you can see it ever so slightly broke the top edge of that Asia range and then came up and broke this top edge. And that one was gone. It was very clean. You're going to be able to eventually see these on the edge when you put them through the viewer. Again, I see my channel. This is the typical false move channel. But what you'd want to do then is you'd want to go through GC for the entire week. Say, okay, if I go all the way to the front of the week, can I spot errors that I might make? Okay, there's a type 1 London pattern. And you would actually pick out ones that would be ones that you, like, for instance, this is not a London pattern to me. It never gave the second leg. It was more of a half Batman. That's not a type 1 London pattern. Hey, you might find one this week that looks just like an M above and takes off. This one never gave the second leg, right? Never gave this. It did give a New York reversal, which was quite nice up here. Okay. It went sideways as GC normally does. This is why I trained myself early on to grab the top edges of these. That's the basic idea that I present to the group, is trading the edges. But here's one, for instance. This is quite nice. I don't know if this made the list. I don't think it did. Okay, there's another one. This was one leg in the box and the leg out of the box, but it's that same London pattern. That one worked out. So you'd want to go in and find the ones that didn't work out. So we're going through GC, and you're able to cut through hours of time here, right? So there was a stubby one. This doesn't really qualify, but again, lovers of the EMAs might indeed see this as an ID move. And sure enough, close above, that's an ID move. It's an ID 50. On up it goes. And in fact, I had a markup here of that particular set inside the viewer. So yeah, when I give out these trade setups at the end of the week, you'll see that I also include the reference pictures that you can load into the viewer, and you can look at the markup. So an ID 50 played out. It's not really a London pattern, but you can still see this small little W down here. You can still see it trying to perk its way up, and then you got a nice trade. So we just went through an entire week of GC looking for this type of thing right above the Asia range that didn't work out, or we were looking obviously for this that didn't work out. But we didn't find any. We didn't find any type 1 London pattern failures. So that's the type of thing that would have to happen for somebody that wants to generate a win-loss ratio. Go back, and it's easy to do with the viewer. Look how quickly we're able to run through these pairs, right? We could do the same thing. What was the other one that worked out this week? It was an EC. It was also very stubby. No, this one was the large one. Okay, so you take EC all the way through the week. How quickly can we go through the week? I'm using my scroll wheel. Go through the week. Let's say, for instance, that you saw this as a London pattern. I mean, it's obvious that it closed below, closed above, closed below. You're waiting to get the entry. I honestly would not be looking at this because of the outside structure that presented the day before. And as well, you had this shift already that they basically cleaned out all the shorts back here. Person's probably not going to want to re-engage at that point. But let's say you took this as a loss. Okay, check. That's a lost type 1 London pattern. Okay, so that's what you'd have to do, is you'd have to go back and find all the ones that didn't work out. And then when you have the two together, you can begin to be like the stenographer and find small rules, find small exceptions for why you wouldn't have taken this trade back here. Okay, the reason that I wouldn't take this initially is it looks like an AR50 to me. And that's one of our trade setups that we have. To me, it looks like an AR50 the way it did this and came back up and then came right back down. That's one of Carr's trades, so I don't want to go into it in terms of the details. But it was screaming AR50. So maybe you start a rule based to yourself, AR50, I don't want to trade against an AR50. I don't want to trade against an AR50, and that keeps you from taking this setup. So you want to force setups when you initially get into this type of material. You want to force it. Let's see what we have here on Wednesday. Okay. Not really a London pattern. Let's see if it closes below the catch-up. That's actually a possible New York reversal. Worked out fine. Okay, so New York reversal closed below. This was a London pattern that happened late. This is a similar type of thing, actually. This should have been on the database. Let's go ahead and add it. Simple enough to add it. I'm going to come up here, type 1 London pattern, and that's going to be a New York version. So now it's added to the database, so now it's updated. So that's how easy it is for us to add our trades into the WSM viewer. And the main idea is that I have accessibility to these charts quickly. So there it is now. So I can see that it was a New York London pattern. It's the same thing. Here's your Asia range. You get the break above the Asia range. Notice it tapped the 13 EMA, pulled back, and then closed below it. So it's still a London pattern, but it's late. I think I termed this a New York reversal. Should have called it a New York London pattern, because they're doing the same thing. They're just taking longer to do it. They've induced long, induced long, induced long, and then finally strip them of their shorts. Okay, let's look at the next day, Thursday, roll through the day. What do you see? Nothing. I don't see a type 1 London pattern in there. I do see something else in there, but I don't see a type 1. Looking for a type 1 London pattern on Friday. What do I see? It just rolls over. I see something else in there, but I don't see a type 1 London pattern. Okay, so it's that quick to walk through your entire week to see if you're in your trade strategy. Okay, so if I'm in my trade strategy, I'm generating realistic expectations. I'm taking the hits even though they come in clusters, and I'm understanding this idea. I have to ask myself when I'm stopped out, am I in my system, or am I making stuff up, or did I not do this type of work to begin with? So we did a very rudimentary bit of work here. We said we're not going to trade against AR50. So again, with the viewer, this is how quickly you can go through these trade setups. You might even want to save this one. So let's just go ahead, and even though I'm completely forcing this because I would never take this trade, but let's just say Control Shift A. Let's do type 1 London pattern. We're going to call this one stopped out. Okay, so that's going to be the comment. So when you actually pull the trade up, it's going to have that comment to it. So this is the type of thing that would speed up this idea of getting into a strategy. All right, so if I'm looking at it, I think this is the one. And if I pull it up, obviously it says, look for London pattern. It's the other one. Is it this guy? Nope. Yeah, this is the one, stopped out. So you can see it says stopped out. So I can analyze the losers this way very quickly. I can go by exactly what the candle action was in front of it, what happened before it. I can get my level scenario worked out. I can become cognizant of the fact, well, what happens if they break this level and they stay below that level, right? Occupy some time. They're going to obviously do a stop run against it. And then this bar right here, you'd be absolutely not even part of longs anymore. And those are the types of things that you're going to get as an ancillary, as an additional learning experience. But the main thing is I'm able to jump into this type 1 London pattern and extract out the ones that might be something I took as a stop out, analyze it, and then maybe I get to the point I say, all right, no trade against anything that looks like an AR50. Okay, so that's going to be obviously a car trade. All right, so I might make that note for myself, and then I save the marking, and there it goes. So now I can, anytime I come to this, I can look at that and say, okay, why am I taking this trade? Why am I not taking this trade? I can turn hints off, which is actually the big deal here. Turn the hints off. I come to this chart weeks later. I come to this chart maybe a couple weeks later. Let's refresh here. Another one. Let's go back to this one. I come to this chart a week later. And do I remember the rule that I made for myself? Do I remember what was there? I see the blue dot, and then I click that, and it tells me no trade against anything that looks like an AR50. So these are the types of modifiers that you're going to put onto a signature trade that is going to make you able to gradually work your win-loss ratio better and better and better. It'll start 70-30, right? And as you put all of these details in, you get it up to 80-20, which is where one of Carr's trades is. The H150 bounce is up into the 80%. Okay, so that is something that obviously he's done the work for you on that one. There are also people that are self-directed that would rather design signature trades on their own and would rather, maybe their schedules don't work out to watch an H1 chart because you have to watch it all day long. It's a longer trade. Maybe people just want to trade inside of our London Gap area. That's one of the trades that I specialize in. It's what happens right in this box and not much more. And it really depends on your lifestyle and what you're doing. But the bottom line is that once you have this stuff quantified, you have a quantified trading strategy, you're no longer looking at it from the standpoint of, oh, I hope it works. Oh, it's not working and it hasn't worked 8 times. It must mean it's garbage. You get out of that fantasy mind. Okay, there's a fantasy mind that operates in trading most of the time. All right, that is pretty much going to be that. I want to just have a look here. Any questions anybody has? Okay, good. I like it when it's quiet because I know you're taking in this information. Anybody have any questions? Reasonable expectations of take profit. Thanks. Okay, so you're asking, that's, again, this is why you would sit in front of this thing. You'd actually get in front of these. Obviously, in a trade that's trading against an AR50, you're going to not get any profit. But let's go back into this. Okay, yeah, we have a lot of trading rules for take profit on all of these. Okay, you enter into this one, and up you go. All right, where's your take profit in here? All right, that's another one that you'd want to go through. Being that you have 338 of these things in the database that you're looking at, what is the standard, let's say, take profit before it rolls around? Maybe we can find some that don't make all that big of a move. You want to always hope for the best, but obviously that's not, in our case, realistic. Okay, you can see some of these just take off, right? Here's one that turns around. What is this move? What is your typical move? I know Steve goes into this. He's heavily into the statistical side. He's done some sessions on this actual topic. That was the stop out, obviously. Do you recognize the stop out by now? I do. And that was just by triggering. We created these visual triggers. So I will always remember that as a false London pattern. Okay, let's see what else we have here. Let's go back a little further in the month. Let's go back to, I guess that's not in the database. There are a couple of these that didn't make it through. That's all right. So let's go back to this one. Let's take one that looks really clear. Okay, there's a nice one, EJ. Okay, so the other side of the viewer is, and this is what I like about it a lot. There's nothing I don't like about it, but this right here, you're going to take this trade. It's a type 1 London pattern in line with the EMAs. What is your take profit on it? Okay, we understand that our stop loss is outside the reach of the dealer below price. What is your take profit on it? Okay, you have to ask yourself the question. Now, what's great about the viewer is I can travel through 300 of these things. Whoopsie. I can travel through 300 of these, plucking them out of the database, and I can ask myself that question. I can actually drill myself on the edge. Okay, I'm in. Oh, am I scratched out? No, I didn't scratch out. I'm still in. I'm starting to think of take profit in here. So me personally, I'd probably click it there. Okay. And you can actually test yourself. And I've done this, hundreds of hours of doing this. All right. And I didn't study this one before we got on together. Okay. I did not study this one before we got on together. But that's what is going to happen. Let's say, for instance, you're learning a new town. Let's compare this trade to a new town. You're in some, I don't know, some exotic city in Europe that has the little cobblestone streets and they're really close together. And in the center of town is this great bakery with amazing pastries and the best coffee. And it's a great environment. But you live out in the suburbs. So you walk into town and you determine that you're going to take every possible route to that bakery because you really want to get to know that town. You're going to want to take every possible route to that bakery because you really want to get to know that signature trade. You're going to take every single one of them so you really know the best way to go. You want to find the fastest way to go or the most efficient way to go, the way that has the most scenery, the most lovely scenery. So you would literally take that city street map and hit it from a different way every time. You can see immediately our human brains aren't wired to do that. Our human brains are find the way to get there and just keep that same route. That's the rut that we're in as humans. We take our straight path and that's it. But with trading, you're compelled to do the secondary route, tertiary route, all these extra routes. And it's the same with these type 1 London patterns. I can go through 300 of them tonight on a Saturday. The market's not open, but it is for me. I can go back in and take hundreds of these and see where they go, right? And I can take them on the edge and I don't have to be, there's no stress, there's no money involved. Okay, here's the London pattern. Let's take this one. I'm in here, stop loss below. See where I take this, EMAs. Getting interesting up here. I might think about looking at possibly taking profit here. That's just what I do. I know GJ is a big mover, so it might be stupid to take profit. So I take half off, stop loss to break even. Okay. It runs up, and up here, maybe I'd take the rest off. It's the full range of the day. Okay, so you're able to actually ask yourself that question, and the viewer answers it for you. So there's, if you really held that, obviously, is the high of the day. So this would have been why you'd take half off, maybe in here, stop loss to break even, and then the rest you'd be able to make for gravy. GJ does run a lot. So again, ask yourself the question, how many pips should I take? So I can answer this question to you, Eng, and I can say, you should take blankety blank number of pips on this. Well, you have a few things that are in your way in asking that question. One of the biggest things that's in your way in asking that question is, what pair is it, right? All of the pairs have different personalities. Each pair has a different personality. There's no question. GN runs a lot longer than UF. And at the same point in time, the way I function as a teacher is I'd rather not give you that. I'd rather not say, take this amount of pips. What I'd rather you do is go through what I'm doing here with you right now, which is actually taking these on the edge and getting a sense of where our trade is going to go. And saying to yourself, I'm in this trade, I'm going to hold. Right? And saying to yourself, I messed up. So this is the type, again, it's Saturday night, the market's not moving, but it is for us. That's how you train yourself. So right here would be a great example of scratching out. I'd say, okay, well, if I would have taken the trade off right in here, I would have scratched at break even. If I take my trade off here, I'm basically scratching before a stop loss, right? So you're going to play. I want you to play with the market. I want you to play with it. I want you to get used to it. Like a cat gets used to his legs by running around and playing, right? You want to get used to it. So asking yourself how many pips of take profit I can take would be a disservice to you. I'd say whatever you do, get with the viewer and start your own analysis of it and take these on the edge. I mean, every human is smart enough to learn details that no machine could ever learn. All right. So here we had the break above the Asia range. Okay? So again, I'm not going to try to say take blank amount of pips. You can do that. We have ways of doing that. I know one of Carr's rules is, I'm struggling not to give Carr stuff away because it's actually very important to him. But anyway, that's one of Carr's rules you could apply to London patterns easily, but I'm not going to do that. I don't want to do that. Okay, but this is the ideal. Retail traders don't have enough experience typically. This is how you can front load experience. We've gone through hours and hours of charts in this small time period. Okay. And let's see, how did you turn off the hints? Control Alt H. Control Alt A. If you go if you go F1, the F1 key, it shows all of the quick keys for you. All the quick keys. If you just hit F1 key. Okay. Should you have a stop loss, you should always have a stop loss. Right. That one I will tell you because I don't want anybody that's gonna not join our group get stuck. Your advantage when the dealer is doing his thing is for you to keep your stop loss outside the low of the day. So you want your stop outside. That's the advantage of this trade, or any trade that breaks the Asia range like this and reverses back around. So your stop loss is outside the high of the day or the low of the day. Okay, good. Okay, so can you tell me what an AR50 is? I'm somewhat new to this. That's Carr's signature trade. That's Carr's territory. But you'll see it. I mean, again, join the class. Work your way through the instructor videos. In Carr's material, he talks about an AR50 trade. Okay. You're very welcoming. You're welcome, Kevin. All right, guys. I kept you a little long, but I was running into technical difficulties, and it worked out all right as it is. I will look forward to seeing some of you Monday night for the pre-market session. Obviously, everyone join Sunday's session, open house session tomorrow with Doug and Carr. It's again, it's more of a casual environment where they're going to talk about a lot of things that are important, and you'll get a sense of how they look at the market, how they progress through their particular evolutions. Okay, it's very important to look at the market through other people's eyes sometimes, especially when you're learning. And for those that aren't going to join us, I wish you good luck. I hope you can easily remember this trade, and I hope that the first thing you do is go back and find the ones that don't work out and see why they don't work out and start to try to filter yourself from taking those trades. And that is what's going to make you a quantitative trader. And that's what's left out so sadly of most retail educations. Retail trading education is about throwing you into a trade, and that's it. Here's the trade. I want to throw you into this trade. There's one slide I want to go back to on this. I want to throw you into a trade, and that's it. When you become familiar with this idea that the weakest link is always going to be your consistency as an operator, when you see that for real, you yourself want to go back and look at the failed trades, in some cases, as more important information than those trades that worked out. When you do that, you become intimately familiar with the charts as they played out before the trade failed. All right? Every time you do this, you're benefiting yourself. And it's always the weakest link. So again, most trading systems get people in hyped out on a particular signature trade. Obviously, we have some of those with Carr's material. You can go in and grab a signature trade. It's already designed for you. You can forget about self-study and all that. You can do that. Okay. But most retail systems won't tell you what's behind everything. They will show you a signature trade and just have you do it, and you'll run into these various things that we talked about tonight, especially the clusters of losses. Clusters of losses. All right, guys. Oh, you don't need to buy anything separately to get access to all of it. So if you buy the class, you're in, right? And believe me, we paid a lot more when we bought this class. At least I did back in 2011. A lot more. I had to sell some stuff to take the class, to be quite honest, and I didn't mind doing it because it was a great leaf to turn. And I knew the second night in class that this was it for me. I could have gone back to my high-low drills that I did my first day of class that were pretty insane. I was doubling demos the second night of the class. And I was obviously thrown into John Wayne mode. John Wayne just shooting from the hip. And doubling your account doesn't seem like a big deal, but I had never done that before in one night. I'd never been able to do that. And so all I saw was some of Steve's charts, saw the material, and was like, man, I could double this account. Damn, what can I do next? And I had to relearn this part about the signature trades and going through all of this material. And I had to go through this idea of clusters of losses and risk. I wasn't using any type of risk management when I doubled an account in demo in one night after Steve's class. Any time of the year, of course, you can join any time of the year. There's no doubt about that. You're free to join anytime. We're here. We're going to be here. We've been here for a long time. So we have a lot of fun. We trade first and we teach second. So that's why I'm going, into an hour here instead of 20 minutes, because you can't rip me from the mic when it comes to this topic. And same with Carr. He enjoys what he does, and he enjoys hanging out with people, and he's always a blast to be with. So, this is how we recharge our batteries in some ways. I'm a junkie on Saturday nights for the viewer anyway. So when we hang up, I'll guarantee you with no exception, I'm putting in 3 hours of chart study that's going to involve going back in the viewer and finding false signals. I'm going back to find trades that might have stopped me out of a particular signature trade I'm studying. Yes, it might be in the year of 2017, but it doesn't matter to me because all the stuff is right on the edge. And not only is the year 2017 right on the edge, but I have all these other lovely time frames to choose from. From 2017, I can see the daily, I can see the 4 hour, I can see the 1 minute. I can go back to all these time frames as if they were right now. I can go back into the 1 minute as if it's right now in 2017. So I'll guarantee you that's what I'm going to do with my Saturday night. I'm going to go back and look at a particular signature trade I'm interested in. I'm looking for the times that it didn't work out. So 4 hours at very, very least. Okay, so any questions you have on sales stuff, please hit Doug with this material. Doug, you want to step in? Looks like there's a question there for you. Okay, he's getting the questions. All right, so I'm going to just, if you have questions, drop them in. I don't want to do the disservice of knocking people out if they have questions about joining. That's a good thing. Again, my story with joining was, it was kind of a Hail Mary because I was in a really good business and I stayed with my business long enough to learn a trade. All right, that's the big thing you want to do. Join the group, but don't kill your day job. I kept my day job for the first 8 months. Then after 8 months, I was sending Steve my statements, 15% a week, 15% a week. And I forgot to show the Skype I got from Simon. Simon took his week up to 15%. So he got 5% on Wednesday, and he's doing 15%. He did a 15% a week. That's my target. That's I've got material, obviously, in the forum about that. But generally speaking, I did 15% a week after 6 months of being with Steve and showing him and sent him the statements every month. So by the time 8-9 months rolled around, it was a lot of fun to engage with other students, and it works. The bottom line, okay? Yeah, good, Dan. I'm glad you got something out of it. There's a ton of material here that we gave. I mean, hey, again, we're in this as traders. We're not in this as teachers and marketers and sellers and all that. So of course you got a lot of free stuff because, hey, we don't mind. It's not going to take away from our material. Again, we lead our lives in trading. We secondarily teach it. And I want you to understand that for yourself. You need to flip that for yourself. You need to keep your income coming in so you can pay for your secondary education that is the trading that then leads to becoming a successful trader. No trade on this planet starts with you just immediately being super successful. It's always this trial and error and experience. The big key is experience. And that's why this viewer is so important, because I can get experience on the M1 chart. I go look at the M1 chart through all this time. Look at a great tea time trade there. I can go through the M1 chart from 2017 as if it were in real time. People don't study their interests in many cases like they should. You should study this market as it's moving. So that's another reason I love the viewers, that since it's moving, and yes, we do have a viewer that cuts this down into every 1 minute increment. You can see it's chunking forward in 15-minute increments. But when you study a market when it's moving, right? What am I doing here? What am I doing? What am I doing? What am I doing? You're asking yourself these questions as the chart is moving. You're having experience in a moving market. So you want to study things in motion if your industry of interest is in motion. Okay, great. All right, guys, we're going to let you go, but it doesn't seem like any more questions are running in. We're going to reorient you back to this side of the boat. So I want to wish everybody a great night and have a good weekend, and we'll see you Monday night. We'll see you Sunday night, actually. Doug and Carl will see you Sunday night. Take care, everyone. Big hugs to you all, and have a lovely evening. Bye-bye for now.